So I'm really excited today to be joined for this investment panel for San Antonio Inc. I'm Mark Medici. I'm the publisher of the San Antonio Express News. So thanks, guys, for joining us. Go ahead and introduce yourself.
Yeah, thank you for having me. It's Kurt Colomb, and I'm with the Cetera Advisors, and I started my career in 1993, and I'm happy to be here.
My name is Josh Lynch. I'm Director of Portfolio Management with SWBC Investment Company, an RIA here in San Antonio, Chartered Financial Analyst. Very excited to talk about the topics that are on the agenda today.
Having me. My name is Dustin Whittenburg. I'm a local tax attorney that focuses on all sorts of federal income tax issues.
Great. So I'm just going to start with kind of a general question about the market. I kind of introduced this in the opening. In my lifetime, it is the most from a Dow and a NASDAQ perspective. I think that it's amazing to see the growth of the marketplace. I think the Dow and NASDAQ both yesterday closed, not yesterday, but on Friday closed at all-time highs again. We seem to be kind of tripping over all-time highs in the Dows and the NASDAQ. But inside of the Dow and the NASDAQ, there are just wild swings of growth and losses. Sometimes inside of sectors, sometimes inside of the same sector. Like bio, for example, there have been a couple companies, Moderna, for example, just wild growth. Even some speculative bios will jump 15% of the day, only to see the very next day maybe a 17% decline. So just amazing swings in the market. But I want to just start each one of you, just kind of, let's talk about the market in general. And Kurt, I'm gonna pass it to you first. We kind of every 7 to 9 years we see a market reset. This is a lot different than 2008, but we definitely had a market reset in last March. So just kind of your take on the market. Where do you see the trends heading?
These are great questions, Mark. And first of all, I want to thank you and your organization for having me here. It's really an honor. That being said, to give you some background, I began my career in 1993, so I've seen a few market cycles. I've got the wrinkles to show for it as well. This one's a little different, as the pandemic adds in a whole new dimension that folks have witnessed this firsthand. Parts of the stock market are very pricey, others are not. You definitely have to tread carefully. There is one camp that feels that the growth in earnings justifies lofty valuations and that companies will grow into the higher valuations in the near future. The numbers we've seen recently tend to support that theory. For every company reducing their forecast, there are several others increasing theirs. However, we are far from out of the woods. I can assure you of that. One of the things to watch is a too aggressive Fed policy that could throw a wet blanket on this party very quickly. The rise of the virus mutations and its continued effects on many sectors of the markets is frankly not to be ignored either. So, tread carefully. Fun times indeed.
So if you could talk about just kind of maybe the challenges of inflation, the risk of inflation, various mandates that could affect the marketplace, and just if you could kind of riff off of John in just kind of the globalization of what's happening, that'd be great.
Well, it's a great question. I'll try to unpack that.
Okay.
With regards to inflation, there are a number of factors that come into play here. Number one, most of the world, including the U.S., shut down for a period of time. There was very little, if any, productivity taking place. At the same time, we relieved people from mortgage obligations, moratoriums on rent payments. We rolled out a variety of transfer payments to make sure people were made whole, as in some cases they were forced to leave their jobs on a temporary basis. And in many cases, we compensated them at much higher levels than they were actually earning from their regular jobs. So you've got a dynamic where nothing was really being produced. Factories were taken offline. People are being flushed with cash, and there's nowhere to spend it. There's nothing to do. The restaurants aren't open. Movie theaters aren't open. Theme parks aren't open. Airlines, you basically could buy a whole row for the price of a single ticket. Now, as things reopen, you've got people that have developed cabin fever, that are flush with cash. They have delevered their own household balance sheets. If you look at revolving credit levels from where they were pre-pandemic, they're down significantly. So now, as everybody kind of reopens at once, you've got all these dollars chasing very few goods, and you still have pockets and flare-ups of COVID variants around the world that are impacting these supply chains. And there was some conversation earlier about the globalization and about global supply chains, but I think what we have uncovered here is that there's a vulnerability with some of this globalization. We lost access to pharmaceutical inputs. We lost access to chips. You've got hundreds of thousands of finished Ford F-150s sitting at a racetrack in Kentucky waiting for the final components to come in. And so right now you've got people that have had cabin fever. They're flush with cash. They want to get out and they want to spend it. But production was taken offline globally through these various global supply chains to where there's just not enough product to satisfy the demand. Interestingly enough, I read a piece in the Wall Street Journal ran where the heads of these major port authorities don't think this is going to end anytime soon. They're predicting we're probably at the earliest going to be looking at the summer of 2022 until some of the congestion and some of these supply chain constraints start to loosen up a bit. So the Fed talks about transitory, but how do you define transitory? Are we talking a month, 3 months, 6 months? Or are we talking, so I guess the devil really lies in how do you define transitory and how do you define short term? Because you've got 44 container ships parked outside of the port in Long Beach. They're waiting on average 8 days to park their boat. There's not enough labor to unload the boat. There's not enough truck drivers to transport this stuff around the country. There's not enough warehouse workers to unload these trucks when they arrive at their destinations. So you've got a lot of dynamics at play. Now, federal benefits ended, I believe, this weekend. And I believe that is going to force people back into the labor force that have been on the sideline for various reasons. The latest JOLTS report showed nearly 11 million job openings, which exceeds the number of unemployed by almost 2 million. So I think we will, from the labor side, start to see some of this stuff normalize as people re-enter the workforce. But as long as COVID variants flare up in areas where we're currently producing some of the inputs that we need, we're still going to be at the mercy of what is happening in other parts of the world. And I think one benefit that will come from this long term, and you're already starting to see it, is companies are going to get a little bit smarter about how they calibrate their supply chains. And you're going to see a little more diversification geographically, with a lot of that stuff potentially even coming home, so that we do have more control and our ability to produce is not handcuffed to another country or another location halfway around the world.
But as you think about just the change in administration from a Trump administration to a Biden administration, what's been the impact of taxes and policy changes of taxation on the market? And I'm actually very curious about what you see coming as we head into 2022. At some point, the bills are going to have to be paid. And to Josh's point, if this continues to persist and the government is continuing to pump money into the economy because of supply chain issues or other logistic issues, at some point that bill is going to come due, and it's going to come due in the form of a tax. Or I think it will. I'm not the expert, you are, so I'll let you answer those questions.
So first, please don't shoot the messenger, because what I'm about to say is probably going to cause some people some consternation. I would like to point out that the last time the tax code was revamped as dramatically as what the Biden administration and the current House has proposed was 1986. And in 1986, those tax changes came in and basically turned the market on its head, right? And led to the early 90s and Resolution Trust Company and all of those things. The Biden administration, the current House leadership, have proposed dramatic changes Some senators have proposed doing away with stepped up basis and estate tax and other things that are likely not going to make it through. And I think that's what you see the market pricing in is that there's such thin majorities in the House and the Senate that it's very likely a lot of this stuff gets passed, but it's dramatic, right? That they're not talking about small changes. The second thing I would point out to you, and by the way, in my role, I don't give business advice. I give technical advice on topics. But I will say the stuff that I see, the deals that I see, and I've had this conversation with several people that a lot of them look like they're priced to perfection, right? That they're priced to the point that nothing can go wrong or the deal comes apart. And by the way, the one thing I've learned about 2020 and 2021 is perfection's not going to happen. But back to the tax changes, I foresee them doing something. I don't know what that is. All I know is that the rhetoric of the party in power during the last election was they were going to tax the rich. That was a plank in their platform. They got elected shouting that from the treetops, which was the first time in my lifetime I'd ever seen a politician elected saying they were going to raise taxes. And the rhetoric has focused on taxing the rich. But if you note in some of the more recent rhetoric, they're talking about taxing the affluent. If I were guessing, I would say this is a redo of every politician that says we're going to tax the rich. They run on taxing the rich. And then whenever the tax code changes are put in, they practically tax the middle class. And the interesting thing about the pandemic is the middle class has really been hurt by the pandemic. I'm not going to say they don't exist. I'm going to say they've really been hurt. And if the idea is they're going to tax the middle class to pay for all of this spending, I think they're going to have some real political challenges. And that's really all I think I'll point out there.
Okay, so I'm building a house in San Antonio. I am really confused, and I like to think of myself as being pretty fiscally conservative. So if I'm confused, I can't even imagine what some people are thinking. Some people's house evaluations have gone up 50% over the course of the last 12 months. People make a lot of mistakes. How do you view the housing market? What do you think the traction of the current market has? And how are you guiding your clients from making mistakes?
And I think really at the end of the day, with respect to the rapid rise in home values, the data seems to suggest that it's a simple equation of the suddenly low rates and a limited supply of homes. We were already seeing prices begin to level off and in some cases trend down in key markets. So that, that does seem to be good news, and depending upon who you are. You can track the rise in home values throughout most historical periods of rate cuts. There tends to be an inverse relationship between the two. So again, if you take a longer track, and of course the other fellows that you've got on the call here have been through several markets as well. So I'll be interested in their opinion as well. But I can tell you that some of the mistakes I've seen with people over the years and with respect to housing, number one, I've seen people treat their home like an ATM machine. That's very common. They've underestimated the cost of renovations and cost of ownership. We see that a lot, and simply people buy too much house for their income. We seem to see that trend repeating itself. So I typically tell people there's two programs: the large house program and the small house program. Many folks over the years always felt a big house could be sold later to fund their retirement. That plan works until it does not. Mm-hmm. I can tell you that during 2008 and 2010, there were some sad faces. The small house program allows for more saving and investing, and mathematically typically crushes the large house program for overall financial success rates. So, that may be a bit academic, but I can tell you that the report just came out this morning, And of the money that people cashed out, 1/3 of it was a big number. I think it was $63 billion that people refinanced and cashed out. 1/3 of it went to renovations, 1/3 of it went to pay off debt, and 1/3 of it went to emergency spending. So, history does kind of rhyme, as Mark Twain would say. But as far as home interest rates going forward, you got to remember the Fed has an incentive to keeping them reasonable. Now, I'm going to date myself here, but I can tell you that when I hear clients bemoan a rate above 4% as highway robbery or whatever label they want to put on it, I remind them that my first mortgage was in the double digits. And I'm not even that old, okay? I don't think. We now have a whole generation of adults that have known nothing else other than a low interest rate environment, and they think that this anomaly is the way things have always been. What I would do, I tell people for first-time buyer, I try and encourage them, even with low rates, to get to the 20%, because you want to avoid that private mortgage insurance, or PMI as they call it. If at all, the rates have gone up, it's a dead cost. Or if you don't have 20, get to 10 or 12, and as soon as you do, your home's gone up in value, and you can tell the mortgage company to get that off because you are at 20% equity. Go ahead and get that off as quick as you can. I hope that helps.
Great. With the favorable rates from the Fed to make sure that we don't do anything damage to the economy, do you see the rates then maintaining that same favorable trajectory? So kind of talk about how real estate incorporates into someone's total investment strategy.
I'm a little old-fashioned when it comes to looking at houses. Kurt had mentioned earlier people using houses as ATM machines. I adamantly oppose going that direction. Taking equity out of a home, you're working under the assumption that houses are always going to go up. And I think we all learned back in the 2006 through 2010 time period that there's no guarantee that that's going to happen. And when you're taking equity out of a home under the assumption that the home is going to continue to keep appreciating, if it doesn't, you're now converting an asset to a liability. And that's just not a very prudent decision. So when it comes to housing from a personal level, the people that want to trade up, get the extra bathroom, maybe an extra bedroom or an office, just don't bite off more than you can chew. Low interest rates have allowed people or enabled people to buy more house than they normally would. You work it out, you run the numbers. How much house can you afford at a 4.5% interest rate versus a 2.5%? There's quite a bit of variance there. From an investment perspective, number one, I think Wall Street has already kind of snuffed this out. You're not really getting real positive returns in any fixed income type instruments right now. In fact, I think as of most recent report that came out from Deutsche, 85% of the high yield market currently provides you with a negative real return. 85% of the high yield market. We repeat that. I mean, spreads are currently at 318 basis points, 250 basis points below long-term norms. And in an environment where inflation is heightened, in an inflationary environment, hard assets are a good place to go. And Wall Street has kind of figured that out. And they have very aggressively moved into the single family housing space to essentially cash flow these units as people are moving away from the big cities. They have more optionality when it comes to where they work. And, they figured that out, and the house prices have remained tight. Another contributing factor, which could be unwound here over the next 6 to 12 months, is Zillow ran a report recently showing you've got about 1.8 million households currently in some type of forbearance program. Those are all going to be rolling off here over the next probably 6 to 9 months. You could potentially go from a very undersupplied environment to a oversupplied environment very quickly if even 25, they modeled as much as 50% of these homes entering the market due to a variety of reasons, whether people lost their job permanently, whether they were structurally thrown to the sideline, which tends to happen after every major recession. You find structural unemployment in certain sectors within the economy where those jobs just don't come back. at least not to the same magnitude. That could cause a leveling off. It could even cause a decline in house prices. Again, going back to the original point, which is why you don't treat houses like ATM machines. It's a place to live. It's a place to raise your family. It's a place to build equity for yourself over the long term. Do I think we're going to see a pronounced or really deep dip in housing? Probably not, because there's an awful lot of dry powder within the private equity space looking to continue to build out their single family home portfolios. It's going to make it more difficult for people trying to, start that household formation process and purchase a home. Obviously, it's going to drive that cost up because they've got the dry powder. They don't have to borrow all they can for very cheap rates, and they can lever the properties to expand the size of their portfolio. I think there are secular tailwinds, just given the fact that we have a very large swathe of Gen Z and millennials that are now reaching that point where they're making money, they're in the workforce. And although they were a little delayed, you're now starting to begin that household formation process. Unfortunately, they're doing it against a backdrop where prices are considerably higher than they were even 3 years ago, much less when I bought my first home. Not to date myself like Kurt said, but way back when. So, the fundamentals are there for home prices to continue to go up. But I do think there are opportunities and pockets for there to be some real turbulence in that space. And so people need to tread carefully, make sure that what they're buying isn't a speculative decision, but a decision that best fits the needs of their household or their future household.
So as you think about a home as an asset from a tax perspective, how are you kind of playing into this both if you have any comments kind of on the boomer side, as well as kind of this Gen Z millennial group? They're very different in their motivations to buy a home. So from a taxation perspective, I'd love to get your perspective on the housing market.
So first, you have referenced the tax code provision that changed under the Jobs Cuts or the Tax Cuts and Jobs Act during the Trump administration, where they effectively raised the standard deduction to such a high point that most people can't itemize their deductions anymore, even with a mortgage and interest deduction. The reason you were told that is that if you got a mortgage and you were deducting your home mortgage interest deduction, it was almost an entry into itemizing your deduction. The Tax Cuts and Jobs Act of 2017 did away with that for most people. And furthermore, for baby boomers who might own two houses or own a vacation house in a high property tax area or a high cost area, the Tax Cuts and Jobs Act capped, I believe, it's property taxes and state and local taxes at a certain amount that makes it even less attractive to those folks to own those homes. And so very much the house has become much less of a tax shelter as it once was, although it's still there if you're able to itemize. With regard to what I see with baby boomers and millennials, to me, it's a lot like their preferences in furniture, right? The baby boomers all own antiques that they think are worth a fortune, and all the millennials that they buy from IKEA. And if they buy an antique, it's something that's mid-modern from the 1950s that nobody really but them likes. And so it's really kind of a taste preference. And I think I'd let the certified financial planners talk about how home ownership works into people's financial plans. The one thing I have seen with houses and taxes, and I hate to be a little rain cloud here, is that there are a lot more people who owe tax debts to the Internal Revenue Service. And so I've seen them filing lots of tax liens associated with houses. And I've seen the revenue officers very much more focused on, what they like to phrase as addressing the home equity when you're in a collection matter or position than they used to be. They're much more focused on either having the taxpayer borrow money or sell the house to address that equity. And I think the financial planning around it, I think I'll leave to the pros who have all the degrees and stuff on the call.
I want to talk about the whole financial self, and one of the things that that I'm now reliving through my parents' eyes, right, is I have a 19-year-old daughter who's a freshman in college, and I just can't. I get in trouble from my wife because I'm only always talking to Eva about her retirement, and I do worry about just kind of these kids, to be frank, in terms of how much is coming at them in terms of balancing their entire financial well-being. So that was a big question, but I think you get the gist of what I'm trying to circle around.
The general trend is just the opposite. They from what I'm seeing, they are really focused on saving, which is good. Boomers had a bit of well, they created a lot of wealth. They definitely blew a lot of wealth. So I think you're seeing that they don't want to be that way, seeing an emphasis on investment and saving, which is good. But to really answer your question, I'll try to attack that in a multi-pronged approach. I was trained by the Ed Slott organization, which you may or may not follow him. He's quoted quite regularly in the Wall Street Journal and that type of thing. But his theory, and I support it, is that you really need to focus on the Roth programs, the Roth IRA and the Roth 401k. And I can tell you that one mistake that I hear every week, I have to explain this concept to high income, educated, non-educated, younger, older, is how a Roth 401k works. Most everybody now understands the tax treatment of a Roth IRA and sees the value in a non-taxable distribution upon retirement. However, Roth IRAs come with some baggage. There's income limits on who qualifies and who does not. Where people drop the ball is they do not understand that they more than likely have a Roth 401k available to them at their current employer. Maybe not, but the chances are very high that they do. These income limits do not apply to a Roth 401k, and people walk by this every day. So if you've got access to a 401k plan, your plan probably has the Roth option. So the same limits apply. A person under the age of 50 could potentially invest $19,500 into, if you're over 50, you can add an extra $6,500 on top of that into your Roth 401k. Now, you need to talk to the tax advisor on the call, but for most clients, it's hard to justify not doing the Roth, especially what we've gone through. The amount of debt that this country is wrapped up, it has to be paid back. And it's going to be paid back by tax increases, okay? You have to realize that your entire life savings could be at risk to excessive tax during retirement. That is the problem. It's not investment risk, okay? That is not the issue. The issue is your daughter getting down the road and having a large 401k balance exposed to excessive tax, and it can decimate what that income will potentially be from that plan. We are currently in a historically very low tax environment, and that's going to change given the rate of debt accumulation and what we've been going through. Whether or not they choose to hire an advisor or not is really a personal choice. I've been a certified financial planner for quite a few years. I got my CFP, I don't know, 15 years ago or so. I've been in the industry practicing in some facets since 1992, so quite a few years. But I can tell you that the person or organization that they choose to hire need to add value beyond what they charge. Many folks feel that the role of an advisor is to beat the market. And I can tell you nothing is farther from the truth. The role of an advisor is to help you cut through the noise, to see your situation from 30,000 feet and help you avoid large pitfalls. So that's, that's another mistake we make as well. They think that an advisor's role is to beat the market, and that's just not the case. Okay. One other mistake that we're seeing on a daily basis is making the transition from an accumulation investor to an income investor is very challenging. Accumulating for retirement takes diligence, but it is a somewhat simple formula. Invest regularly, keep your expenses down, live below your means, and before you know it, someone like your daughter will have saved enough to hit their goal. That's the easy part. The hard part is converting your savings to income and not running out of money. You're not getting a second chance at a 30-year career. So you have to really think through it. 30 some odd years ago, a person could invest $1 million in a CD and potentially get 10% or better, which would pay $100,000 a year in annual income, and still have their principal guaranteed. Right? In today's lower environment, that same $1 million in a CD would pay you less than 1%, about $10,000 in annual interest. I mean, the difference is stark. Investors have to seek out many different ways to generate income with these low rates. The role of a good planner or planning group cannot be overstated to help clients design retirement income programs that will last through multiple market cycles. I could talk about this till cows come home, but I hope that's helpful.
John Toohey and Josh Lynch from SWBC, I really appreciate it. Kurt Colomb from Elliot Associates Wealth Advisors, thank you so much. And Dustin, the tax guidance. Dustin Whittenburg is a tax law attorney. He has his own shingle, his own law office. So, hey guys, I really appreciate that very much. I hope you have a good rest of your day.
Thank you for having us.
Thanks for having us.
Thank you.